stockholders' equity. On the left, the amounts invested by the shareholders, those will be shown in stockholders' equity on the balance sheet as contributed capital. A second source of stockholders' equity is the amounts that have been earned by the company. Those are shown on the income statement, basically net income, and sometimes this category is called earned equity. On the balance sheet, this shows up as retained earnings. The third category includes items that are not included in net income. So these are changes in balance sheet accounts that bypass the income statement. Those are shown on the balance sheet in stockholders' equity as accumulated other comprehensive income. You've talked about this before in Accounting 3110, and the type of items that are included here are changes in available for sale securities, some translation gains or losses on foreign currency, and some derivative transactions. This graphic is similar to the prior one, but it shows the same classifications in terms of the accounting equation. Our focus in this particular chapter is on stockholders' equity, owners' claims against the resources. As we talked about and shown below the blue graphic, we're going to break those owners' claims into three sources: contributed capital, retained earnings, and accumulated other comprehensive income. Contributed capital are dollars paid to the corporation for its stock. We're going to break contributed capital then into two pieces: common stock and additional paid-in capital. And what is recorded to common stock are amounts paid to the corporation as legal capital. These are based on the par value or the stated value of the stock. Amounts paid to the corporation for stock beyond that par value or stated value are additional paid-in capital. The second category, retained earnings, this again is net income that has not been distributed to the owners as a dividend. In this class, we'll deal exclusively with entities operating in the corporate form of business. To begin a corporation, the sponsors of the company would file a corporate charter with the state where the corporation has decided to incorporate. Different states have different laws regarding corporations, and corporations can elect to incorporate in whatever state has the set of laws that fit their needs the best. The corporation doesn't have to have a physical presence in that state, and they don't have to do business in that state. In the United States, most corporations do business incorporated in the state of Delaware. One of the reasons for that is it has the most developed set of corporate law in the U.S. Looking at the corporate charter, it contains a number of items of information that are important if you're thinking of investing in that corporation. One of the issues that's the most important to us is the number and classes of shares authorized. Owners of the company's common stock have a number of rights, some of which are detailed on this PowerPoint. One of those is the right to vote in terms of the board of directors, any kind of shareholder initiative. Shareholders also have a preemptive right to maintain their percentage ownership. And what this means is that if the company decides to issue additional shares of common stock, the current shareholders have to be given the opportunity to purchase shares such that their percentage of ownership remains the same. Common shareholders also have the right to share in profits if the board of directors decides to declare a dividend, and they have a right to a share of the remaining assets if the company is liquidated. From the corporate charter, the authorized number of shares establishes the maximum or highest number of shares of capital stock that the company can sell. This graphic illustrates cutting the number of authorized shares into two pieces, those that are issued and those that are unissued. The issued shares represent shares of stock that have been sold where the company received dollars for these shares. Those dollars would represent contributed capital on the company's balance sheet. What this graphic illustrates is splitting the issued shares into two categories: those that are outstanding, still owned by the shareholders, and those that are sitting in treasury shares. Treasury shares are shares of the company's stock that were issued but have been repurchased by the corporation. There are two types of capital stock that a company can issue. Those two types are common and preferred stock, and we'll talk about common stock first. Common stock is the most basic type of equity, and what that means is that if the corporation decides to only issue one type of stock, it would be common stock. Common stock is the residual part of stockholders' equity, and stockholders' equity itself is the residual, or what's left over of assets after liabilities have been liquidated. So common stock represents the residual part of residual equity. These shareholders would receive distributions only after creditors and preferred shareholders have been paid. Now, why would anyone agree to have such limited rights to assets? Well, the reason is that there's no upper limit on the return that these shares can receive. If the company does very, very well, then the return to the creditors and to preferred shareholders is limited. The return, however, to common shareholders is not limited on the upward side. The second type of capital stock is preferred stock. This category of stock is called preferred stock because it has preferences or better rights than common shareholders have. Typically, those better rights relate to dividends. Two rights that are commonly associated with preferred stock are the cumulative provision, which means that dividends that are skipped in 1 year must be paid before the common shareholders can receive a dividend. And the second preferential right to dividends is participation. This means that the preferred shareholders would receive a stated return and some of distributions beyond that percentage. An additional right associated with preferred stock is the right to convert into common stock. This gives preferred shareholders the right to exchange their shares of preferred stock for shares of common stock. The benefit of that to the preferred shareholders is the unlimited upper return on the common stock. So a preferred shareholder that has the right to convert into common stock would exercise that right when the common shares have done very well in the capital markets. When companies issue stock, they record the fair value of what was received and use that to value the stock that was issued. In this example, the company is issuing 20,000 shares of stock that has a $10 par value from the Articles of Incorporation, and they receive $18 or a fair market value of $18 per share. So in total, the company receives $360,000 of cash, 20,000 shares at the $18 per share fair market value, and that $360,000 increases the corporate assets and it increases contributed capital and stockholders' equity. However, we're going to record the legal par value of $10 per share to common stock, and the difference between the total par value of $200,000 and the $360,000 fair market value received, that difference goes to additional paid-in capital. That's the $8 per share that the company received for the stock beyond par value. When a company issues stock but receives an asset other than cash in that exchange, it can sometimes be questionable as to what to record for the stock. For a publicly traded company where the value of the shares issued is known, the best estimate of the fair market value of the transaction is the value of the stock issued. However, for a company whose shares are thinly traded, or for a non-publicly traded company, the value of the stock issued may not be determinable. What happens in those circumstances is the company would first look to see if they can make a good estimate of the value of the asset received. If so, we'd use that as the proxy for the total fair market value in the transaction, and the stock issue would be recorded based on that value. The step down and the least good alternative is that the company simply estimates the value of the stock that was issued. This would be done if the asset received, really it was difficult to determine its value, or you weren't sure what the value of the stock was. Another accounting question that arises with the sale of stock is, what if the company issues more than one type of security? In that situation, the accounting issue is, how do we decide how much of the value received goes to each type of security? There are two accounting methods that allocate the amount received between the classes of securities. Those are the proportional method and the incremental method. This is an illustration of using the proportional method to allocate the value received over the two classes of capital stock. Regardless of which accounting method is used, the value received is $30,000, and that's the total value that will be allocated to the shares of stock. Another way of saying that is the company has increased their assets by $30,000, and they've increased contributed capital by $30,000 also. The question that we're grappling with is how much of that $30,000 goes to common stock and how much goes to preferred stock. The proportional method uses the security's relative fair market value to determine the allocation. So in this situation, the common stock is worth $20,000 out of the $32,000 total fair market value. So that security receives 62.5% of the value received, or $30,000. The preferred stock picks up the remainder of the fair market value, and the value allocated to that security is $11,250. In total, this approach has allocated the $30,000 between the two securities. The incremental approach allocates the same $30,000 to the two types of capital stock. It simply approaches that allocation a little bit differently. In this scenario, the company knows that the fair market value of the common stock is $20,000. So what they say is, out of the $30,000 received, we know 20 of it was for the common stock, therefore the other $10,000 will be allocated to preferred stock. So the same total of $30,000 is allocated. The specific amount allocated to common and preferred stock differs slightly between the two examples, but are fairly close. Share buybacks are a frequent transaction that happens when a company decides to buy some of the stock that it's previously issued back from the owners. These types of transactions, from an accounting perspective, we call treasury stock. These transactions are considered a distribution to owners, similar to dividends. The financial statement element that categorizes that distribution to owners. These transactions reduce both sides of the accounting equation. They reduce assets and equity. They have no impact on the income statement because these are transactions between the company and its owners. And lastly, these shares have none of the rights associated with common stock. So treasury shares do not have the rights to vote or to receive dividends. There are two accounting methods that are used to account for treasury stock. The two accounting methods are the cost method and the par value method. The dollar amount in the name indicates the amount to record to treasury stock. The cost method is going to record the cost of the shares to treasury stock, and the par value method records the par value of the shares reacquired to treasury stock. Notice that the accounting method does not affect cash flows. The amount paid would be the fair market value or total stockholders' equity. Regardless of what gets recorded to treasury stock, total stockholders' equity is going to be reduced by the same dollar amount. To illustrate the two accounting methods that can be used for treasury stock, we will use the following example. The company had previously issued stock with a $10 par value for $18, and they decide to repurchase some of that stock. We'll look at three transactions: purchase of 5,000 shares of treasury stock for a fair market value of $15 per share. The company sells half of those shares at $20 per share, and they sell another 2,000 shares for $11 per share.